Hello and welcome to another episode of Darwin Investors. First of all, I'd like to say thanks to the folks that are tuning into this channel. I really never expected so many people to watch the videos. And I know it's still a really small channel and it probably always will be, but I do appreciate those that check in and check this channel out. Secondly, I guess there's a lot of hate being out there in YouTube land for financial content creators for selling out of stocks or selling out of the market or what have you. I'll just let you know, I sell stocks all the time. And so I guess should prepare for some hate. And I mean, I wouldn't blame anybody right now for selling completely out of the market, I guess. I wouldn't do it, but I'm just saying I wouldn't blame anybody for selling completely out of the market and then just moving into trading. And not because investing is so bad, although it's not great right now, but not because investing is so bad, but because trading is so good. The volatility is so high that you can get pretty decent premiums on stuff like cybersecurity stocks, selling puts way out of the money, and you could run a whole portfolio just with trading. As a matter of fact, pretty much all the money I've made this year has just been with trading. My investments have not been that great yet. They will. I would probably question someone if they were to say sell out of their Amazon and Google right now. I think that's something you might regret in a year, but again, I don't know. Maybe you wouldn't regret it. Maybe that it doesn't do anything then. But for all I care, buy and sell whatever you want. Buy Dogecoin if you want to. I wouldn't do it, but go ahead and buy Dogecoin if you feel like it. I'm going to show you why I think that right now investing is not as bad as people are making it out to be. And I just want to point something out real quick. So I'm going to share my screen here. And we'll do this before I get into what this video is going to be about. So the reason why I don't believe that right now investing is as bad as people say it is for two reasons. One is that traders, from this article, this is from March 22nd, just a couple weeks ago, traders bet on an aggressive Fed and predict half-point rate hikes in May and June. So if you look at what this article is saying, traders are betting the Federal Reserve is likely to raise interest rates by a half percentage point at each of its May and June meetings to battle inflation on a faster clip. Market expectations for a more aggressive, quicker rate hike cycle rose after Fed Chair Jerome Powell's tough talk on inflation on Monday. The Fed is expected to reach 2.25% on the Fed funds rate by the end of the year and a peak of 2.75% by September 2023. So the market, whether we know it or not, is already pricing this in, or it's already done. So if you're selling now because you are trying to escape this, it's too late. This has already been priced in, or it's being priced in right now. Second reason why I think it's not, you shouldn't really have to sell out of all your investments, it's not as bad people think, is when I look here at the 10-year Treasury note, historically it's still pretty low. So we're looking at about 2.5% here. I would say that probably until it gets around, say, 4%, we're probably okay. Like, you got to have an incentive to go buy bonds, and right now 2.5% isn't enough incentive to go from equities to bonds. And you can see that we haven't been over 4% for quite a while. As a matter of fact, this market's been ripping since about 2009, and it was 3.84% then. It was a little bit slower back here over 4. So I would say 4% is our tipping point, but we're nowhere near that right now. Nowhere am I sure that we'll get there at all anytime soon. So for those reasons, I think that the market is actually in better shape right now than people are making it out to be in the media, but of course fear sells. Okay, so what's today's video about? Today's video is about what would 52-year-old me tell 22-year-old me? What advice would I give that person, all those years ago? And I started thinking about this. I said, well, I'd tell 22-year-old me, make sure that you max out your retirement accounts, in a tax advantage retirement accounts like a Roth IRA or a traditional IRA. Make sure that you get employer matching, max that out, any sort of 401k employer matching, make sure you're getting that. Make sure that when The equities that you choose to put in there is a well diversified index fund, something like an S&P analog. And then why don't you go ahead and sprinkle in some bonds, so make it about a 60-40 split between equities and bonds. And then when you retire and you get your pension, you can supplement that retirement with 4% withdrawal of your bonds to help you in pay your bills later on in life. And then 22-year-old me says, well, that's nice, but instead of doing all that, can't you just you're from the future, right? And I'm like, yeah, I'm here from the future. I'm 52-year-old you. And well, can't you just tell me what stocks are going to grow the most over the next few years? And then I'll buy those and I'll take it from there. And I said, 22-year-old me, I like your style. We should go out and party sometime. So that's what we're going to do. We're going to look at what what Schwab, according to Schwab, is going to be the biggest growers over the next few years. And so as we can see, if you look at the S&P 500 here, this is the S&P 500 biggest stocks now versus 10 years ago. Now this was done about a year ago, and year and a half ago. And then here are the companies that were biggest in 2011 versus in 2021. And you can see that in 2011, some companies were a little bit bigger by market cap. Exxon was bigger, IBM, Chevron, and that. But a lot of these companies pretty much stay the same. There's just a little shakeup, but they're by and large, they're a lot of the same ones. Now, some move in, like Facebook and Tesla, but that's kind of more the exception than the rule. If you look historically over S&P 500, the companies don't seem to change much. One that I think is interesting is Amazon was clear down here in 2011, and now it's way up here. And I think that we would expect that it might go clear to this spot here pretty soon. And then other companies just fall completely out. They're just not good companies, like GE here. They were losing money and they weren't a great company. AT&T had bad management. It's fallen down, but they're still in the S&P 500. They're just further down the list. So we're going to use Charles Schwab's analyst forecast to predict the future here. And the way we're going to do this is I'm going to skip down here to peers and ratio comparisons. And down here, Schwab has an EPS growth forecast 3 to 5 years. And if you look here, it says this is defined as long-term growth is an estimate of the compound average rate of growth an analyst expects over a 3 to 5 year period and is expressed as a percentage increase per year. For the purpose of the spreadsheet that I put together to project this growth, I've maximized it and gone for the full 5 years. And so doing that, I would take these percentages and then I add it to the current earnings per share, and then we get an earnings per share after 5 years. And then based on these analyst estimates, I can reshake up the S&P 500 top 10 on their projections. And then I can also look at, more importantly, what is the expected growth we would expect per share of certain select companies throughout the S&P 500, because we don't necessarily want to own the top 10. We kind of really want to have the ones that are going to generate the most money over the next 5 years. You want to get into those stocks. Also important, this is going to be the profit margin. You can see that Apple has a very nice profit margin at 26.5%. Dividends are important as well. This sheet was really put together. They did a really nice job. So these are all functionalities that Charles Schwab had, but you had to like hunt and peck for it all over their website to get all this. Now they've consolidated all of this into one nice little package here. If you have it, I recommend you trying to use it. It's a lot to take in at first, but once you get used to it, it's pretty nice. I mean, you got your Morningstar ratings, Credit Suisse, Reuters down here. At the bottom here, you've got, all of your balance sheets and stuff like that. There's some reviews. They're not really in depth on this page, but they still have their legacy page if you want to look at that as well. So like this is what the sheets used to look like in Hunt and Peck. But off of this sheet, I'm going to use the earnings per share off of this sheet to start, and then we'll start multiplying that by the growth percentage that I was just showed you, and then we'll come up with growth after 5 years. So the way I was ranking this is I'm going to do it with some assumptions here. So the way I'm going to forecast the growth is going to be on the growth forecast that I just told you about. And from that, I made a spreadsheet. I'm going to assume there's no buybacks or dilution of stock. And of course, that's unrealistic, but I've just made everybody, straight across the board, no buybacks or dilution. Of course, all companies do stock buybacks, and some of them do it really aggressively, and they do it quarterly, like say a Union Pacific really does that aggressively, and they do it quarterly. I'm going to assume that the 10-year bond yield remains under 4%, just because I want, if I'm going to predict price to earnings ratios, they tend to be, price to earning ratios will be higher if the bond rate is lower, because people aren't incentivized to go out and buy bonds as much. Growth matters. I showed you that on the bottom of that little box, it shows the growth rate. So I'm saying if a company is growing at 30%, we'll give them an extra 5 price to earnings ratio, and 20%, 25. So by and large, it's always just adding 5 to the price to earnings ratios. It's just something I put out there. I noticed that it's fairly accurate, actually. If you look at companies, how they're growing versus their price to earnings ratio, there seems to be a correlation there. Other things that matter are going to be their CEOs. Some of these CEOs are just better than others. They're more visionaries. And some of the most visionary CEOs out there, if you're thinking about visionaries, you think about Jobs, Gates, and Walt Disney and that. Right now, to me, the biggest visionary out there is Jensen Huang over there at NVIDIA. Of course, Elon Musk, you have to throw him in the mix. He's quite the visionary. I mean, he's at 2 companies that are successful now, PayPal and Tesla. And it may be a little bit too visionary at times. Man wants to colonize Mars and put out that truck. Hey, look, you know what? Some people love that truck, but to each their own, I guess. Reed Hastings at Netflix. Satya Nadella and Jensen Huang are going to get together, and there's companies are getting together to make software that will actually interpret your speech. Like let's say I'm speaking in English, and you only speak, say, Japanese. It will take my words and it will translate it to you in real time in your preferred language. And I think that's really cool. That's like straight out of Star Trek or something like that. Jack Ma over at Alibaba. I mean, that guy's quite the visionary. Unfortunately, he's being a bit suppressed by his government. But if he wasn't, he'd be just thought of just like Bezos over there, Jeff Bezos. And then you've got your salesman CEOs, and these people, I think they're fantastic for a lot of reasons. A lot of people should be taking a page out of these guys' books, because when you report company earnings, sometimes, like let's say that you have good top and bottom line beats, your earnings per share beat, your revenues beat, but then it's like, well, but you guided a little bit low, you missed by 1 penny, and then it just wrecks your stock. Well, that's your professional type of analysts and traders that are doing this, or maybe some computer algorithm that's just going ahead and just selling off these stocks and wrecking them. And that's because they haven't embraced the retail trader as much. They're kind of like beholden to this establishment or this institution. And these CEOs tend to break that mold and understand how valuable the retail trader is to having your stock price be very, well, first of all, elevated relative to your earnings, and also steady after a poor earnings report or something that wasn't quite was expected. These stocks tend not to get demolished. Certain CEOs could take a page out of this book. People like the guy at Netflix. Split your stock. Reed Hastings, split your stock and embrace the retail trader. People love Netflix. You could do this. Bob Chapek over at Disney, embrace your retail trader. Maybe your stock would do better. The guy over at Chipotle, for crying out loud, that stock is $1,500 a share. People love your burritos. If you freaking just do a stock split, we will buy your company. And if you have a poor quarter or whatever, your stock is not going to get annihilated. But right now it will. So the salesmen really count. And then of course you got your innovators, people that keep the stocks rolling really nicely. They take what they have, they tweak it, they make it just a little bit better. And I've listed a few of my favorites right here. I'm going to have some bias when I rank these, and that's because I'm kind of bullish on certain things. I'm bullish on the internet. I think the internet is going to stick around for a while, so I'm bullish on that. If you turn on CNBC, they think tech's going right down the tubes. They'll say, well, you got to have value over growth or something like that. Even when the growth or the value stock is trading at a higher multiple than your supposed growth stock, they're like, well, it's tech, so I'm going to have to sell it. Well, no, I'm pretty bullish on the internet. I think I'm pretty bullish on tech. I'm bullish on cars. I think we're going to have those for a while. I'm bullish on houses. I think that those are going to stick around. I mean, you'd think that no one's ever going to live in a house again if you've been watching CNBC for the past week or so. But really, there's some merit there. I mean, we're probably at a peak in the housing. It's probably going to go down. But again, if you're selling your housing developer type stocks now as a result of all this news coming out, you're too late. So you might as well hang on to that and sell some covered calls or something against your underlying. Computers, again, I'm bullish on computers. I think they're going to be around for a while. And on this list, I also gave a little bit of points for pricing power. So let's go ahead and take a look at this list. Side of this list, we've got our top companies right now in the S&P 500. And this would include, then they're ranked by market cap. And then I've taken on this here, the Charles Schwab earnings per share growth and their operating margins and put them in these categories. I've ranked their dividends. And from there, I was able to use the future earnings per share. And let me just show you really briefly how I got that. So when I went over here, I would show that this company, Apple, had earnings per share of $6.02. So it'd be 6.0233. And then when I look over here on this sheet here, we would show that Apple was growing, according to the analysts, over 3 to 5 years, 14.85% per year. So I take that number and I multiply that by 1.1485, and that would mean the earnings per share after 1 year would be $6.95, and then I multiply that by 1.1485, and this would be after 2 years and so forth until we get the number after 5 years. And I did that for all of the S&P 500 top 20 companies, and I did it for some other select companies down the list. So that's how we come up with that number. So the future earnings per share after 5 years for Apple came out to $12.04. And the 5-year share price would be $240, giving them a market cap of $3.92 trillion and a 5-year share growth of 37.5% over today's current share price. Now, again, Apple's going to buy back stock. It'll probably be bigger than this and that sort of thing. But we're just making all things equal. And so you could probably buff up these numbers just a little bit on the right-hand side over here. But that's the way we're going to do it. So the top company market cap wise that I got, and by a long stretch it seemed, was Amazon. Amazon's share price after 5 years, using the ratio here that they had at a 34.8% earnings per share growth, got you a share price in 5 years of $11,521. Google was also really good at $6,981. The top company by market cap would be Amazon. The second one was going to be Google. The third one would be Apple, and then the fourth one would be Microsoft. By these rankings, I was a little bit surprised to see Facebook got so large, but that was according to their analysts. They're going to grow 18.5% a year for the next 5 years. That seems to be a little bit lower than the guide that they have. I think it was 3 to 8%. I don't personally own Facebook, but according to this, it's going to do really, really well. It's going to have a $2 trillion market cap. I was surprised NVIDIA didn't go up as high as I thought it would. It went up 87% per share. but it's might be the next trillion-dollar company. It looks like it is. It's the next trillion-dollar company according to their analyst ratings, and that will be Nvidia. Um, After this, I have a little category here that just kind of like little wild card type stuff. Like this is the price per share after the split after 5 years for Google. They're going to be having a 20-for-1 split. I have after 5 years, the analysts think, according to that, it'll be $349 a share. Amazon will go back to $576 a share. I gave certain companies a bonus for their CEOs. Like we said earlier, I gave Tesla an extra 10 PE bonus, and that might not be enough for Tesla, just for Elon Musk being such a fabulous salesman and catering to uh, his retail crowd. And really, I probably could have given him a lot more than a 10 PE bonus. I could have given him a 50, but let's just go ahead and keep it nice and conservative. And I gave him 10 over what I was doing. So what I would do is I would say Apple has a growth of earnings per share of 14.85. So I would take the future earnings per share and I would take that number 12.04 and I would multiply it by the future PE ratio, which I said if it was growing at 15%, let's add 5. So I'd multiply that by 20, saying that Apple will trade at a PE of 20 in 5 years. Right now it trades at like about a 28. So I might be undershooting this a bit, but if things normalize a bit, it probably should be trading around 20 times. And that would give you that share price there of $240.80. And like I said, certain people got a bonus PE because of who the CEO was. Walmart's PE was going to be, according to this, Walmart was going to have a price to earnings ratio of like 12 or 13. Well, that's not realistic. It trades, I gave it a PE of 20 just for being Walmart. Bank of America was going to have a price to earnings ratio of 20. That's again unrealistic. I gave it a 15 just for being a bank, and that's kind of where they seem to trade. Disney was going to have a price to earnings rate. This is amazing growth what Schwab is having for Disney. I'm not sure why they think they're going to grow at 43% a year every year for the next 3 to 5 years, but it is, I'm just using their numbers. But because I felt that that was too high to give them like a 52 PE, I gave them a 25. And Costco was also going to trade at a really low multiple of 16 times. I gave them a 20 just for being Costco. And so that's the way that those worked out there. Now, some other companies that I looked up that are not in the top 20 of the S&P 500, I looked up, well, Intel is one that people are really high on right now, but their earnings per share growth is not predicted to be very high. It's only 3%. So that's the reason why people are kind of sour on this company, is this earnings per share growth is not considered to be very attractive. Adobe is one that is not growing at the rate that it used to, and I thought it'd be interesting to do them as well. You can see that over the next 5 years, Schwab would say that their share price would appreciate by 14%. Wells Fargo was an outlier. This is incorrect. It's not going to grow 118% a year for the next 3 to 5 years. I didn't bother to do it. I would have liked to have done it, but the Schwab analysts go back and check their numbers. I think that maybe they punched something in wrong or something like that, but it's not going to grow 118% for the next 3 to 5 years. AMD is one that I currently own, one I'm currently interested in. You can see that it's got a very good growth, net income, EPS growth. It's got a very good net margin. And so the share price goes up. It's a very attractive, up 178% over the next 3 to 5 years, over the next 5 years, actually, using this multiple. Netflix is one I was interested in, just because I think that Netflix is innovative and they'll come up with something to boost their business. But they have a 56% growth over today. I gave them a 25 PE rather than a 21, just because Reed Hastings will come up with something and elevate this company a little bit more. And I think it'll always trade a little bit of a premium, especially if they embrace their retail investor. This premium is going to go up to 35. But they have to find a way to embrace their audience. They're one of the companies that can do it. Lowe's is, I made them a 20 times multiple. That would get you 122% return. Deere, Applied Materials, Caterpillar, CSX. CSX, I think, is an interesting one. It's a transport, it's a train. They're very hard to compete with. They're a great company. They don't get a lot of love, but I tend to like them. They're a $30 stock, and I think that it's a really nice company, and they give you a nice return over the next 5 years, according to Schwab's ratings. Chipotle, they're one that also should split. That I don't understand why they're not embracing the people that go out and buy their burritos, you know. And they're one that I think is cool because they actually they aren't really outside of the United States. And I think that, in my opinion, if you wrap it, they will come. Chipotle is getting ready for a global expansion. I'm pretty bullish on burritos. I think that people would like them if they got a chance to go to them. They're opening up some in the UK. They're opening up some in France, I believe. Yep, UK and France. UK, I lived in UK for about 10 years, so I know that that they'll eat it. They like good food. I love British food, by the way, but I think it's very underrated. Give me a lamb shish, and their Chinese takeout is fantastic. But if you go to the co-op and you grab their old El Paso brand of Mexican food, and you start making that, it's got an like an Indian fusion flavor to it. It's not really like Mexican food, but I'm not gonna lie, I think it's delicious. I'll eat Indian fusion Mexican tacos all day long. You might have to do Indian fusion for your Chipotle over there. But again, I think that if you build these things around the world, there's no reason why I think it wouldn't become like another Starbucks or McDonald's or KFC or something like that. I think that people would flock to this company. So there's a lot of room for growth here. And according to this Schwab analyst, you should get an 81% return over this. Some of these that I would say be careful with. Costco here, it doesn't have much growth. You see how the growth on net margin, excuse me, doesn't have much net margin. The net margin on Costco is only 2.66. It's the same with Walmart's 2.43. These are not good margins, and these companies with poor margins don't tend to grow so fast. But I would be careful with Costco. It's trading at a super high multiple right now, and I have it that's going to be down 24% over the next 5 years. Enphase Energy, that's one I'm really interested in because I was thinking about buying it because I just like the thought of the solar power company, and they seem to be the leading one. But according to the Schwab analysts, their 5-year price target of this would be about $44.16. So that's down about 79% from where it sits at currently. So I'd be careful with that one. Ralph Lauren is another one like Wells Fargo. It's not going to grow at 80% a year for the next 3 to 5 years. But man, I really wish that this would have been a more accurate target for this. Again, they probably punched in their numbers wrong and got that. But I think that this is a good small cap stock that has some decent growth ahead of it. Not this good, but good. And I think that you can get a lot of money out of that stock in the long run. So let's go ahead and look at what my findings were. What I'm going to tell 22-year-old me they should buy right now. So 22-year-old me, the number one stock you should buy is Amazon. That's going to go up 251%. 22-year-old me, Facebook, I have it here, should go up 233%. Don't believe it, but it's the numbers that came from Schwab. So that's what I'm going to go with. AMD is next at 178. Bank of America is going to grow 148%. Google will grow 142%. Applied Materials, that one's going to move up the chart. It looks like it's got a really nice growth to it. Applied Materials makes semiconductor equipment. So people that make semiconductors need to get their source their stuff from Applied Materials to make it happen. And that one goes up 136%. MasterCard was a bit of a surprise. I think this is a little optimistic, but nevertheless, I'm using the numbers they give me. And so MasterCard goes up 125%. Lowe's goes up 122%. JP Morgan goes up 99%. CSX goes up 99%. And Costco and Enphase are the only losers on the entire formula that I come up with. So there you have it. That's a wrap for today. If you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Bye.